Tarun, coming to you. Good afternoon. Thank you so much for joining us as well. Obviously, when you're looking at it, mid-cap, small-cap categories, they've shown high volatility, a bit of a mixed return when you look at it versus the benchmark indices as well. And otherwise, mid and small cap in the last 1 year have seen a bit of an underperformance versus the large cap ones, right? So how should investors currently position themselves, their portfolios? What are you advising them?
So, good afternoon. I am of a very different camp, and I strongly feel your financial plan or the structure you have built to create your investment should drive your portfolio decisions rather than the market movements. I have seen that 90% of the long-term returns an investor gets is because of three reasons. First is because of the plan and the structure. Second is the asset allocation discipline, what the investor keep. And the third is their behavior, how they position themselves in the bad market, right? Based on that, only long-term returns comes. And I think human psychology, again, declining investment inflicts twice as much pain as the increasing value increase positive emotions. I think the current last 1 year, I have seen it has come with a back of great 2 years in small and mid cap, micro cap rally, right? And I feel it is nothing but a mean reversion, right? Any asset which will go so strong will again come back. So I think very importantly, investor need to have a plan, need to have a structure. What goals they are investing for? Is the investment for short term, long term, tactical? What is that purpose with which they are investing? Once that part is clear, I feel navigating all these volatile phases will be much better. And for any new investor who is looking at invest, my strong recommendation would be to look at their financial plan, their goals, and their asset allocation. That is the more critical thing. And in that, if a 30%, 40% mid and small cap is required, maybe because the valuations are little elevated, they can do a staggered investing route to invest in the market. That would be my suggestion.
Okay, all right. So, Tarun, but are there any steps that a retail investor should maybe take if the mid and small cap fund of theirs, which they are holding currently, is maybe lagging the peers? And especially over this last 1 year, if you look at some of the names, it's a very contrasting view. Some of them have done terribly, and some of them are still managing to hold on to some bit of a gain. So, what would you tell them to do? Would it be maybe for stop the SIP, which is underperforming, switch? How should they go about it?
I think again, I would like to reiterate why you have invested at the first place. 1 year to review a fund, according to me, is not a right approach. I think you have picked a fund. There was a purpose behind picking that fund, right? So I think small underperformance. Again, these funds, small and mid caps, one need to view with a long-term horizon, at least with a rolling return data of 2 year, 3 years, 5 year, then only you can make a judgment that they are underperforming. A 1 year underperformance is not a reason to act. Again, one need to understand, is this a performance noise or a process breakdown? I would actually look at exiting anyone if there is a process breakdown in a fund, right? Where there is a change in the fund manager, or there is a governance issues, or there could be many things which can happen, right? Which is impacting the performance. So I think those should be the reasons for you to exit, not a simple underperformance of last
Yes,
1 year.
exactly. So when we say not just underperformance, but other major factors as well, Tarun, let me come back to you on this and ask a follow-up, because we are seeing painful phase for mid and small caps. So say if something irks an investor, there's a fund manager change or a strategy change, it becomes not the exact fund where you invested when you wanted to do that long-term investing, right? Where do you advise parking money from that bad fund or that fund that does not suit your strategy? Would it be a hybrid fund, fixed deposit, or large caps if they wish to make that change from the current allocation?
Again, I think the question what you are asking, I feel it is not a proper question, because I think if your allocation of the money is for small cap fund, you can't move that money into hybrid or a arbitrage money, right? It is meant for high risk, right? So you need to make sure that the allocation, if you have made in your plan, is aligned with a high risk investment. you need to keep a 5, 7, 10-year horizon on that. You can't just 1 year of underperformance, you move the money and move into categories. I feel that is a very short-term investing, and this investing will not pay investor long-term dividends. So I am of the opinion that one should follow the asset allocation dharma. That is the most important thing, and that is where the long-term returns comes.
Okay. Following asset allocation and obviously, parking your money which you've allocated mainly for a riskier asset, that is something then you should look at where you could park it later on as well. Doesn't mean you can shift the money.
Tarun, what's your go-to advice for clients? When we talk about underperformance, of course, you don't change the category overall. If it is a high-risk product, you have to go to a high-risk product. But when do you know when to pull the trigger? This is for somebody who was seeing losses for 2 years, but is not sure whether it's the right product for them or not.
I think in that case, that product has not been taken with a purpose. Because I have seen many times, couple of years, 1, 2 years, the fund may underperform. It is not because a cycle can go wrong. Any asset class which can give you double the fixed deposit returns need to have a long term mindset. And if the investor does not have a long term mindset, I think they should not be investing into equity. I think that is my strong suggestion. Again, I am trying to reiterate on that point only. Get your asset allocation and the plan correct. That is the most big problem I have seen with the investors. Investors are not focusing on that, and we are focusing more on the short term things, which ultimately does not matter in the long term wealth creation part.
Tarun, so the question here is somebody invested with an idea of a long-term return. They did do it the direct way. They didn't do it the regular way. So nobody really told them which mutual fund to invest into. They made a mistake there. Some of their funds, the mid or the small cap part of it, is underperforming. So how do they assess whether they should continue with this? How do they assess whether they should pull the plug or they should just go ahead with it? So there must be some indicators. Say after 2 years you do that, after 3 years you do that. Some indication on that.
Yeah, so we normally look at some qualitative as well as quantitative parameters. So in terms of quantitatively, we look at rolling return data for 2 to 3 years rolling return data with category if there is a serious underperformance there. Risk adjusted matrix, if we are seeing the ratios are not correct, if qualitatively if there is the manager true to the mandate, you have taken the money with some mandate and you are investing into another mandate, is the investing style has drifted, is the investment team stable out there, is the AMC scaling responsibly? These are some of the qualitative parameter one can use while using a filter to invest. But normally it is you need to keep a long term horizon when you invest into a small and mid cap fund. It's a lot of patience one need to have.
Okay. Patience is what one needs to have when you invest in the small and mid-cap funds. Tarun, thank you so much, for joining us today, giving us perspective from the market front as well as the mutual industry fund, what investors should do as well. Thank you so much for joining in.